Our next speaker is with Tony Cousins from Perfect International, and they manage the Global Cautious Fund here at Ned Group Investments. Perfect have an excellent track record of protecting capital using their strategy, which is focused on capital preservation. Perfect took over the management of the Global Cautious Fund about a year and a half ago, and during this year they've really posted a fantastic performance of beating their target of cash plus 3%, while still delivering quite an impressive protection of the fund during that period in markets drew down in March. Tony is going to take us through a little bit more about how the year unfolded for the strategy, and then he'll focus on where the markets are, or where they view markets are going, and how the fund is positioned. So Tony, over to you.
Thanks, Doug. Good morning, everybody. My name's Tony Cousins, and I'm responsible for managing the Global Cautious Fund for Ned Group. 2020 was obviously a very volatile year, and I'm pleased to say that in that year, this fund achieved its objective. The slide we have on screen here looks at the breakdown of performance for each individual asset class, and again, pleasing to say that all the asset classes in which we're invested generated a positive performance for the fund. Total fund was up 4.8% for the year. Now, the one exception to this is the cash and currency hedging line, which I will come on to explain, and this is due to our risk management system. Commenting on the highlights, the positives and negatives for the fund, clearly the top line number was positive and above benchmark for 2020. The decision to increase the equity weighting in March 2020, as the market fell sharply and better value emerged, that was also positive for the fund, as equities clearly rose sharply thereafter. The non-US dollar exposure was also a positive, as the US dollar weakened and foreign exchange gains were made in sterling, in Canadian dollars, and in Swiss francs. Both the equity portfolio in the US and the non-US equities contributed positively towards return. Not everything was positive. The currency hedging that we had in place of the Australian dollar, this detracted value as the Australian dollar appreciated 8.9% against the US dollar. The reason that we have this currency hedging position in place is that we manage the overseas foreign exposure within the portfolio between 0 and 45%. 45% is the maximum non-US dollar unhedged exposure that we can have in the portfolio. If we didn't do any hedging, the exposure would be in excess of this maximum, and risk parameters are there for a reason. So we hedge back the most expensive currency, which in this case is the Australian dollar, back to the US dollar. This brings the overseas foreign exposure, which is unhedged, down to just within the 45%. It's 44.1% today, and that is an important way of managing risk within the portfolio. The other thing where we could have made more money for you is by having more aggressive stock selection, particularly within growth sectors. You'll be well aware that in equities in the US in particular, but really mirrored around the world, is that growth stocks significantly outperformed value stocks over the year. We believe that this is now quite extended and is forming something of a bubble. However, that is what happened in 2020, and our position in high quality value defensive stocks, whilst producing a positive rate of return, did tend to lag the market. So let's look at what we did in 2020. The key move occurred in March. When we went into the year, we had taken the view that equities were very expensive, valuations were very stretched, and we had an equity weighting of only 25%. However, clearly, as the COVID-19 crisis unfolded, markets fell very sharply in the second half of March in particular, and this delivered much better valuations. We responded to this by increasing the equity weighting, as you can see on this slide, taking it from 25 to 30%. And as you can see, the entry point into those additional equities was favorable for the fund. Equities recovered thereafter, despite the economic effects of COVID-19 and the lockdowns that were put in place. We saw strong upward movements in equity prices, to the extent that by June, those better valuations had evaporated, and we took the decision to take the profits on the additional equity exposure that we had taken and reduced equity weightings back down to 25% within the portfolio. And that is where we ended the year. As a sort of hot off the press item, earlier this week, we reduced the equity weighting by 5 further percentage points down to 20%. And this was caused by the excessive valuations, which I'll now come on to talk to you about. What we saw as we moved into 2019 is a market that we felt was very expensive. This slide looks at the price earnings ratio of global equities. They entered the year at a level of around 21 times earnings. Clearly, as markets fell, that valuation level improved, and they fell to about 15, 16 times earnings in March, which is when we went in and bought more equities. However, since that point, two things have happened. Firstly, equities have risen sharply, and secondly, the earnings base for those equities has declined sharply. And as you can see, the price earnings ratio on the markets has risen very markedly since that point. It now stands at approaching 29 times earnings, which is really very, very overvalued, and we are very concerned, and that is what has caused us to reduce equities once again in January 2021. Now, this picture is mirrored in the dividend yield for global markets. At the beginning of the year, the dividend yield was around 2.3%. On the world index. As equities fell sharply, that dividend yield improved and actually got to around 3% at the time which we bought those additional equities for you. However, this valuation level has again deteriorated due to two factors. First, the same as with the PE, is that equity markets rose very sharply. And the second is that dividends were cut very sharply as companies lost confidence, and or regulators prohibited dividends from certain sectors like banks. Now, the decline in dividends wasn't uniform across the world. Europe was hit much worse than anywhere else. In the Eurozone, we saw dividends fall 25%. In my country, in the UK, was actually the worst performing, falling 35%. Against this, the US and Asia only fell by around 10%. However, in aggregate, there was a very sharp decline in dividends. And by the end of 2020, coupled with the rise in markets, the dividend yield on global equities had fallen to around 1.8%. Again, another measure of significant overvaluation. The next chart really shows the extent of the overvaluation of the US market. The US market has been the best performing of the major markets in the world, and has been driven really by huge influxes of liquidity by the Federal Reserve to what we would consider absurd, extreme valuation levels amounting to a speculative bubble. This measure of valuation, market capitalization to GDP, is Warren Buffett's favorite measure of how to determine undervaluation and overvaluation within markets. As we can see, that this has moved to more than 2 standard deviations away from its long-term average. Now, that's a lovely bit of jargon, isn't it? What does that mean? If something is outside two standard deviations, it means it only spends around 5% of its time out there. 95% of a time variable will be within two standard deviations. So that is sort of a 1 in 20 occurrence that we're looking at here, and I think that's very indicative of a bubble that is beginning to form in US equities. Coupled with this, the market was not going up uniformly over this time. It was led very much by growth stocks, by tech companies, the so-called FANG names, the Facebooks, the Apples, the Googles, the Netflixes of the world. Now, these are very fine companies. There's no doubting that. They have strong business models, but there is a price for everything. And what we've seen here is these stocks being driven by excess liquidity to really quite absurd levels of valuation. This has been coupled with a collapse in bond prices, and this is what has been used as the justification for those valuations. These are what we fund managers call very long duration assets, because the earnings that these companies will eventually produce are a long way away. And if you use a lower discount rate in the form of a lower bond yield, the present value of those earnings becomes much higher. So these valuations, we believe, are very reliant on extremely low bond yields, and this chart does make that case. So where is the portfolio positioned, or where was it positioned at the end of the year? We had 25% in equities, 72% in bonds, and 3% in cash. Equities were split 10% in the US, 15% in non-US, bonds 30% in the US, and 42% in non-US. In terms of currency exposure, we are on a fully hedged basis right up against that risk parameter. You see 44.1% unhedged overseas currency exposure. That reflects our view that the US dollar remains an expensive currency on the basis of purchasing power parity, which is our key measure for assessing countries, and the US dollar needs to fall further. As that occurs, then the fund will benefit from having that unhedged overseas exposure. As it does occur, we would look to reduce that unhedged overseas exposure because the money will have been made. In terms of bonds, the modified duration of the portfolio is extremely low, 1.5 years. That is a very defensive position simply because bond yields are just too low. They have been driven to these very, very low levels, approaching zero in the cases of Eurozone bonds, actually below zero. This has happened because of the huge influxes of liquidity that the major central banks of the world have been putting into bond markets. And the valuations are now, frankly, absurd. It would just simply not be possible to make an adequate rate of return in the long term holding bonds which yield so little. As an example of this, the German 10-year bond today is a zero coupon bond. There is no income at all. So the only way that you can continue to make a positive rate of return is for the yield, which is already negative, to continue to fall. And we've done some simple calculations that show that to make 5% per annum, which is quite often the expectation of investors buying bonds, then the yield on that German 10-year bond has to fall to minus 6% over the next 5 years. Now that is really quite absurd. It's not going to happen, and so expectations of returns will be disappointed, and this is a further example of a bond bubble. Within our equity portfolio, you will see that we have a very significant preference for Asian markets, certainly over Europe, due to much slower growth in Europe, and over the US. because of extreme valuation. Let's end on something positive. I think the outlook for Asia is far more positive than any other region of the world. They continue to have good growth. They've managed the COVID crisis, very well in terms of restricting the virus and limiting casualties from it. And as a result, they are now enjoying much faster, more robust recoveries. The long-term picture for them looks good. The demographics are much better than they are in Europe and better than they are in North America. Productivity grows faster because it's coming from a low base, and people still save money in these countries. And this stock of private savings is what will fund private sector investment, which will drive productivity forward over the next few years. And valuations are simply better in these markets than they are in other markets. So these are the quality markets of Asia that we're talking about: Singapore, Australia, Hong Kong, Taiwan, Malaysia, and Indonesia. And I think they have a very bright future. So in summary, we have adopted a defensive position. We follow a very targeted value and quality driven strategy. Fund management is all about process. It's about taking the emotion out of the decisions, and that is what we have done for you this year, and is what we are doing for you now. So thank you for your time today, and I wish you a good day.
Tony, Janet Yellen recently came out to say that the smartest thing that the US can do is to act big and worry about its debt later, when she was referring to the 1.9 trillion stimulus program that they're about to embark on. I wanted to ask you what else investors should be worrying about when the US Treasury makes a statement like that, and how you think this may impact the US Treasuries, the US dollar, and potentially US equity markets.
Well, I think I agree with Janet. Actually, this is a horrendous demand shock that we've seen. It's still going on. In some places, it's still getting worse, and it needs economic stimulus. The Trump administration allowed this really to wither on the vine. U.S. unemployment is in excess of 10%, and it's having a horrendous effect in the US and indeed throughout Europe. So the US needs stimulus, and it needs fiscal stimulus because the monetary approach is really largely out of ammo. So this is what's going to happen, and you have the Yellen put and you have the Powell put, and they're both in positions of power now. And I would expect the Fed to fully support the bond issuance that this is going to bring about, and hopefully this will get the U.S. economy out of a hole. But this is leading to huge increases in debt, and at some stage the piper will have to be paid, and this either comes from years and years of austerity, which is politically very unattractive, or it comes through governments trying to inflate out of the problem, and we strongly believe that will be the course of least resistance that they will choose. Powell has already said that he will, if inflation picks up, he will allow the economy to run hot. And I think that's probably the right thing to do. The problem with this is the valuations that are reflected in asset markets. The equity markets have massively discounted the recovery already in the valuations that they're offering, and bonds are simply not priced for any inflation. They already offer negative real yields when there is no inflation. Should inflation start to pick up, you will see some significant capital destruction at the long end of the market. Now, at some point, that will provide a very good opportunity for entry into high risk assets, but not now.
Thank you, Tony. Appreciate your time.